All right, let's try to make sense of today's market because, wow, it was just a complete paradox. We had record highs and sheer panic happening at the exact same time. So drawing on some great analysis from PhilStockWorld and the AGI Roundtable, we're going to dig in and figure out what is actually going on.
Okay, so get this. This is the core problem of the day, right here. On the one hand, you have the S&P 500 just powering ahead to another all-time high close. That screams optimism. But then you look at U.S. consumer confidence, and it didn't just dip, it absolutely cratered to its lowest point in more than a decade.
So that's the big question, isn't it? Is everything actually fine and investors are right to be celebrating? Or is the stock market just floating in its own little bubble, completely ignoring the reality that everyone else is feeling? That's the mystery we need to solve today.
Let's start with what you might call the paper economy. These are the companies whose fortunes can turn on a dime based on a single government announcement. And today, well, this part of the market got hit with an absolute shockwave.
And I mean, this number, it really says it all. United Health, a giant, a Dow component, got absolutely hammered, dropping 17%. When a company that big makes a move like that, you know something is seriously wrong. So what happened? What could cause a collapse like that? It wasn't a terrible earnings report or some big scandal. Nope. It was a policy proposal. The administration basically proposed to freeze payments for Medicare Advantage, which is a massive, massive profit driver for these insurance companies. Just like that, the rug was completely pulled out from under their entire business model.
And this perfectly captures a piece of advice we saw this morning from Phil Davis over at PhilStockWorld.com. He said, stay away from stocks that can be tweeted out of existence. And that's exactly it, right? When a company's whole future can be changed by a politician's decision, you're dealing with a constant, unpredictable risk.
Okay, but here's where things get really fascinating. While that whole paper economy was in a nosedive, there was a completely different story playing out. If you looked at the physical economy, companies that actually build and ship real stuff, things looked really strong.
I mean, just look at General Motors, the total opposite of United Health. GM didn't just beat their earnings, they actually raised their guidance for the rest of the year. That tells you people are still out there buying big-ticket items like cars.
And it's not just cars either. Look at UPS. They also beat their revenue numbers. That's a direct sign that the consumer is active. People are buying stuff, and they're shipping it all over the place. That doesn't exactly sound like an economy on the brink of collapse.
And meanwhile, in the background, there are these huge foundational investments being made. Take Corning, for instance. They just landed a massive $6 billion deal with Meta for fiber optics. That's the real physical stuff that's going to power the whole AI boom.
And this is the really critical part. This demand isn't just a forecast. It's real and it's locked in. Baker Hughes, a huge player in energy technology, has a record backlog. A lot of that is for the power systems needed for all these new AI data centers. That is guaranteed business for years to come.
So you've got this deep, deep split in the U.S. market. And this internal contradiction, this policy chaos we saw with United Health, it's not just a domestic issue. It's actually sending shockwaves around the world and is putting a ton of pressure on the U.S. dollar.
The AGI Roundtable put out a report at the end of the day that really broke this down. They're basically saying the dollar has a trust problem for 3 key reasons. First, what they call the volatility tax. All this policy uncertainty is making the dollar act like a risky emerging market currency. Second, there's a bypass America strategy forming. You see the EU and India making their own huge trade deals. And third, what they call the yellow exit. That insane surge in gold past $5,100 an ounce, they say that's not just a trade, that's a global vote of no confidence in the system.
So, with all this craziness, a strong physical economy, a super fragile paper one, a shaky dollar, what are you supposed to do? How do you even begin to navigate a market this confusing?
Well, the folks at PhilStockWorld offered a really straightforward way to think about this. The goal isn't to perfectly predict the future, it's to protect yourself from it. First, you have to know your risk. How much could you actually lose if the market drops? Second, target your coverage. You don't need to hedge 100%. Aim for about 2/3 of that potential loss. Third, use what are called convex hedges. These are tools designed to pay you back way more than they cost, specifically in a crash. And finally, figure out how to pay for it. Use the income you're making from your good long-term stocks to pay for this insurance over time.
And that really brings us full circle, right back to that central tension of the day. Because despite all that strength we saw in some corners, this final thought from Phil Davis really captured the mood of a lot of veteran traders, just this feeling of disbelief.
that the wider market seems to be ignoring these huge, blinking red lights.
So that's the bizarre story of today. A market hitting all-time highs, driven by real companies building real things, but at the same time, it's haunted by these deep political risks and this feeling that something's not quite right. And it leaves us all with one final critical question. The market is ignoring a lot of warnings right now. How long can that possibly last?